Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit.
So as you're probably aware, we're covering the most popular topics over the 25 calendar year. And this topic in particular was around how to tax effectively get money out of a company. Now, a lot of us all get into the trouble, or a lot of what we've seen from a lot of our clients, they get into trouble around Division 7A loans and unpaid present entitlements and so forth. And they don't understand how they can tax effectively get money out of the company. In this episode, we cover things such as dividend streaming and setting up corporate beneficiaries, and how to set up your structures correctly so that you can tax effectively get money out of your company. So let's get into it.
Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, today Mena and I would like to talk about how to effectively contribute capital into a business entity and be able to withdraw that capital. Now that could be, this could cover a situation where you're starting a business that needs a capital injection, or you've got a business that needs a capital injection to fund growth, or alternatively you're starting a business with a third party, an unrelated third party, so a friend or a colleague or whatever it might be, and you're both contributing something into the business. The thing we want to then think about is, if the business does well, how do we get that capital back out of the business again? And how do we do that in a way that's as simple as possible, that doesn't give rise to as many, or hopefully any, taxation consequences? And that's what we want to talk about today. And it's really thinking about the difference between a company and a trust, and when we would use those two types of entities, and then specifically with each of these entities, how do you structure the capital contribution, capital withdrawal? So I might ask Mena to talk about the company side, and then once he's finished doing that, I'll talk about how to use a trust in this regard.
So getting money into a company, there's really two main methods, and I'll cover off the first quite quickly because it's probably the most simple and most common method to use, and it's great to use for temporary funding. So think about sort of short-term working capital injections, or just to meet day-to-day requirements. And this is where you or a related entity of yours lend money to the company via a documented loan agreement. So generally what happens as an asset in your company that's loaning the money to the other company that requires this working capital. So the secondary company that requires the working capital would have a loan liability to you or the company that has received the money from. Now you've got the option to charge interest on this loan agreement, and it creates basically a deductible expense for the company that's received the money and taxable income for the company that's loaned the money. So again, this is great for temporary funding, and it's probably the most simplistic way of going about it, and it's great for sort of short-term working capital injections. It can also be used if there's multiple owners, as long as there's clear expectations of when and how those funds should be repaid and in what order. So if there are multiple owners, consider getting a complete and well-read basically shareholder agreement, as well as a loan agreement in place to stipulate how and when those funds will be repaid and with the order of priority. The second one, which is probably more complicated, is around share equity. So you can actually, instead of doing debt finance, it's basically equity finance, where the person contributing money into the company has an equity piece in the company in question. So for example, one partner can have 100 shares at $1,000 each, and the other partner can, for example, have 20 shares at $1,000 each. Now in the company constitution, if you don't necessarily want this secondary partner to have voting rights in the business or anything like that, you can issue them without any sort of voting rights. You can issue them, for example, as just preference shares, where they get preference dividend based on a certain event of the business and so forth. The downside to that is obviously, if you wanted to recoup that equity back from that partner, then you'd need to sort of do a capital return, and there might need to be a market revaluation of the business at that point in time to determine what the value of those shares are. So it can work well, just depending on your intentions with the company, where you see the company in a few years' time, whether it's going to be a short-term funding or whether you want that partner with you down the track.
So that's talking about getting money into the company. As Mena highlighted, we're either going to do that as share capital or a loan. In terms of getting that money back out again, of course, it's kind of the reverse of whatever you've decided how to get it in there. So if it's a loan, of course, the directors of the company can determine to repay that loan at any particular time. If it's return of share capital, what you're really doing is reducing the face value of that share issued capital, which isn't too difficult, but requires a few resolutions and forms and so forth to lodge with ASIC. So of course the loan option is a little bit easier. In terms of getting money out, in terms of profit, so if the company's actually generated profit, of course the only way it can do that is either via salary or paying dividends. You can't obviously draw a salary at the end of the year because it's got to go through single touch payroll. So you've got to really probably best determine your salary draws at the beginning of potential financial year, but be careful about the payroll tax. Depending if you've got a big payroll bill already, you don't necessarily want to add to that as owners of the business. So therefore then it's really about declaring dividends, and the key thing here, the key trap to sort of avoid, is just making sure you've got enough franking credits in order to declare fully franked dividends. You can declare unfranked dividends, but that's going to cause a problem down the track because it means that your retained earnings will be lower than your franking account, and it can give rise to sort of unutilized or trapped franking credits. So sometimes in a new entity, we will make that entity pay some PYAG installments before the end of the financial year to build a franking credit balance to allow us then to declare a dividend in that financial year. Bit of a strange situation because, accountants normally like to delay tax rather than pay it in advance, but something to really think about. So let's talk about using a trust, Mena.
So basically with trust, we always, I'm sure we've harped on this about in previous podcasts, but we always recommend a discretionary trust to own the shares of a company. The reason being is it provides you with the flexibility to distribute dividends that flow from that company to your family trust, to family members or related entities. So in any given year, circumstances can change where family members might be at varying tax rates. For example, children might just turn 18, partner goes on maternity leave, whatever it is, there's always going to be something that will vary from year to year. And it just gives you that flexibility to distribute dividends to beneficiaries who might be at more preferential tax rates and can sometimes yield tax refunds as a result of the franking credits involved. Secondary to that, if all beneficiaries are at the highest tax rate, then you can incorporate what is called a corporate beneficiary. So a secondary company that can receive the profits and cap the tax rate at 30%. That's how we sort of park profits tax effectively without having to pull it up at personal rates and pay 47% on those profits. And then we'd use those funds in that corporate beneficiary to invest in. So that's where a holistic accountant would work with your advisor to determine what you're trying to achieve and how those funds should be invested.
The other benefit of a trust is that if we're contributing capital into a trust entity as opposed to in a company, of course we can, like Mena said, we can do a loan or a capital arrangement. If it's a loan, there's no difference between company or trust. But with capital, there's a big difference because I can make what's called the in corpus, a capital contribution into a trust, and that'll just sit on the balance sheet in the equity section, and I can put that money in and take it out without needing necessarily to complete any forms. No ASIC forms, no change to the face value of shareholding, all those sorts of things. It's a lot simpler from an entity perspective, but of course a family trust isn't unitized, so it's not going to suit situations where you're co-investing with other people, or you might want to co-invest with other people down the track. You need a more unitized structure in order to do that. So if you're just doing something on your own, whether it's investing or starting a business or whatever, and you think, I've got to put capital in and take capital out, a trust can be a little bit easier from that perspective. The next thing to think about if we are using a company is to understand that if we do withdraw money like profit without paying a dividend, we're probably going to give rise to a Div 7A loan. And we've spoken about Div 7A a number of times on the podcast. Did a case study back at the beginning of 2023, season 3, episode 2 it was. And so the problem with Div 7A loans is that you need to pay interest to the company, and the company then needs to pay tax on that interest. So while the interest you pay to the company could be a paper transaction, it might not be a cash flow one, certainly the tax on the interest will be a cash flow consideration, actual expense. And the interest rate for this year is about 8.4%. So, if the Div 7A loan is sizable in terms of its loan principal, you can end up, the company ends up generating taxable income, and whilst that could be a paper transaction, the tax on that taxable income is certainly something that's going to come out of your pocket. So just be careful around Div 7A loans. We certainly use them in our business. Sometimes they are necessary, but they're not really a long-term solution. Not always. Sometimes they are very narrow situations they can be, but sometimes Div 7As or large Div 7A loans are a symptom of lack of planning. So if you are in a situation where you do have these large Div 7A loans, it's something that you want to speak to your holistic accountant about to understand what is the long-term strategy around these things.
The other way that you can get money out of the company is what I touched on earlier, is around capital returns. So these are possible but complex in nature. So you can always return capital to shareholders, but it's administratively heavy. So at times it involves a market valuation of the business at that point in time to determine what the value of the shares are. And then from that component, you'll then prepare shareholder resolution solvency declarations and need to lodge forms with ASIC before the funds are actually returned to the shareholder. So it is possible, but it can be costly and time-consuming avenue. So that's why we sort of always recommend going down the simpler path first. But if necessary, you can always go down the equity path if required.
So there you go. It's a bit of a difficult topic to record a podcast on because every situation is different. I mean, that's true with lots of things with taxation, but specifically I think with contributing capital into a entity, whether that's just a non-trading investment entity or whether it's a business, and whether that's a business that you own 100% of or whether you're going to part own with another partner, it's always different. There's always extenuating circumstances. And so whether you do that as a capital contribution or whether you do it via a loan as in debt, it's going to depend on many factors, and taxation is only one of those factors. The contribution from each partner, when you think the entity is going to be able to repay the monies, is having an entity with a liability on its balance sheet going to impede you, maybe from a licensing perspective, or it just depends on what's in your business. So it's going to be different for everyone, but it's really about unpacking the pros and cons of a company versus trust and making sure you have that strategic conversation with your holistic accountant at the beginning to work out a good longer term plan and keep it as simple as possible, but not any simpler. Okay, that's it for us for this week. Until next week, bye for now.